central banks are making an attempt to control the interest rates, whether they're short term, which the overnight rate is a direct function. They say, okay, this is what the rate is, or the longer term bond rates, which is a function of buying the bonds to suppress the interest rates. And they want to control it across the whole channel. Well, Australia, over the weekend, Friday really, and then over the weekend, it was a big fat fail with their interest rates spiking, and that now tests all of the central banks. So we're keeping an eye on that. But that is a huge vulnerability that has evolved, and we'll see if they can get that back under control. I'm not sure yet, but we'll find out. These vulnerabilities may evolve into structural legacy problems, like it did prior to 2008 with the derivatives. Now, all of those, they call them legacy derivatives because they cannot get rid of them. They have to keep paying the fees to keep them floating because they were so unique. So that changed the structure of the derivatives market permanently, and that's what they're talking about here. May evolve into structural legacy problems. Now, on this, I would say it's because everything is based on your never-ending ability to grow more debt, not you or me, but the corporations and government's ability to just continue to grow debt when it's already at beyond nosebleed levels. That puts medium-term growth at risk, or, and here's the piece, testing the resilience of the global financial system. And while I cannot make you any guarantees, I'm not even going to give myself any fudge room. I am 100% certain that the resilience of this global financial system will be tested. And I'm also 100% certain that it will fail the test, and that will justify ushering in a whole new system. But in the meantime, do they really want you to know or understand what's going on? No, they don't. Because if you really understood that the currency was going away, that this little thing, whether it's a digit in your account or whether you hold it in your wallet, it has no value. It seriously has no value. So they create policies really as much to hide the risk, because what do they always talk about is expectations, inflation expectations, right? As long as the public is moving forward, perception management are tools that help the public move forward in a way that supports central bank policies. So let's take a look at some of those. And we've talked about this before, but this is in the report. It's absolutely true, and I want to talk about it more with you. Default rates are set to remain low based on rating agencies' projections and on credit spreads. So let's break that down. The rating agencies like Moody's, S&P, what we know, because they have admitted it and we've talked about it, is that they have made conditions for their grading a whole lot looser and easier than they really should be or were. And that's why we've had that huge growth in triple B, which is that one level above junk. When a lot of the issuers in that triple B range should be junk, just based upon the standard parameters that Moody's and S&P usually or has in the past. I mean, look, we see this before every crisis. The grading agencies that are paid by those that issue the debt, right? They have a vested interest in giving them the best possible score, or they're going to go someplace else to a different grading agency to get the score that they want. So can you really believe or trust the rating agencies? Heck no, you can't. Could you in 2007? Heck no, you couldn't. Can you in 2021? Heck no, you can't. But the market still relies on that, and therefore they pay less. They have lower interest rates. Now here they're talking about, and by the way, as long as they're investment quality, then these bonds, these debt issuances can be held in certain products like pension and retirement products that if it was junk category, they couldn't by law, because it's in their prospectus, they couldn't by law hold. The bottom line is you can't trust the rating agencies' rating projections. You can't. And on credit spreads. In other words, the difference that you're in interest that you're going to pay on a junk bond versus an investment quality bond. You're not getting paid to take the risk. Rising gold price is an indication of a failing currency. They don't want you to know that this garbage is dying. They don't want you to know that. So what they do is they make the stock markets and even the crypto markets, let them go up because those are all intangibles. But let us suppress gold and silver. Let us suppress real money so that you don't go there. I mean, it makes it easier for them. Well, in the meantime, what I'd also like you to see is that they're saying that there's $2 trillion in notional value, so nobody really knows how much is really at risk, but $2 trillion. But thanks to financial engineering and netting, what does it show up as? 0.02 trillion. Substantially lower. Wow, thank you, netting. See how handy it is to have the ability to create the rules as you go along, and when things don't happen the way you want them to happen, just change the rules. Don't change the behavior. Well, let me tell you, I think we all need to take a really hard look at ourselves. And if you are counting on the fiat markets to save you from this collapse, well, you know, maybe you need to rethink that. Because they don't have your best interest at heart. Gold and silver has your best interest at heart because you hold it and you own it outright. All this other stuff, they're just contracts. That's what they are, contracts. Could you actually tell me how many ounces of gold they are suppressing or they have created just by all of this derivative garbage and all of this netting? No, and they couldn't tell you either. We are so vulnerable that one little change can topple the whole Jenga economy. So when that happens, what do you need? You need physical gold, you need physical silver that is decentralized and outside of the system.